Everyone's waiting for the Bank of England to cut rates aggressively, but the bank's chief economist just poured cold water on that idea. Huw Pill says cutting rates too far or too fast could actually reignite inflation. Here's what that means for mortgages, inflation, and your next. Right now, the base rate sits at 4% after 5 cuts since August 2024, but inflation is creeping up again, expected to hit 4%, double the bank's 2% target. Now from the screen here, Huw Pill, you can see one of the more hawkish members of the Monetary Policy Committee says the risk of cutting too much too quickly could undergo progress in bringing inflation. His main concern, service inflation and wage growth. They've stayed high even as energy and food prices stabilize. The latest data shows wages are still growing at 4.7%, whilst unemployment nudged up to 4.8%. That combination, high pay growth and slow job creation, keeps pressure on the bank to stay more cautious. So if the bank moves too fast, it could risk another surge in inflation, which could mean higher rates for longer. But if it holds off too long, it could hurt households and businesses already struggling with borrowing costs. So we've actually hit a crossroads. Cut too soon, inflation spikes. Wait too long, growth stalls. Either way, the next few months will be crucial for mortgage rates. Now, if you're looking to move, remortgage, what does that mean for you? From what Huw Pill is saying, the Bank of England is going to take a more cautious stance and aggressive rate cuts will be off the table, at least for now. Expect a slower pace of reductions with policymakers waiting for consistent inflation drops before acting. And inflation is still sticky in services and wages. Unlike energy-driven inflation, service sector prices and wages are harder to call. These tend to feed into long-term inflation trends, a key reason why the bank wants to avoid acting too fast. And if you've got a mortgage, you shouldn't expect rapid mortgage rate drops. While money markets expect cuts as early as February 2026, lenders may hold off adjusting pricing until they see clarity from the next Monetary Policy Committee meeting. Short-term rate deals may stay higher than expected in early 2026. And if you're a homeowner or buyer, you need a long-term strategy. This isn't time to take a gamble on quick rate falls. Focus on securing stability, whether that's locking in a short-term fix or planning for affordability in case rates plateau. So the bigger picture is controlled disinflation over quick relief. The bank's goal isn't cheap credit, it's sustainable price stability. If it gets it wrong, inflation could rebound, forcing sharper hikes later. The message, slow and steady, wins the key takeaway for you today is the Bank of England is not ready to go all in on the rate cuts just yet. Expect caution, smaller moves, and a longer path to normalization. For borrowers, that means being proactive, not reactive when it comes to your next mortgage decision. If you're looking to remortgage your current deal, check out the 5 biggest mistakes in this video here. But that's your mortgage update for today, and I'll see you on the next headline.